Over the year to February 2022, US goods inflation excluding food and energy surged to a 12% pace as global production disruptions and extraordinary demand collided. Fast forward 16 months to June 2023, however, the situation has almost entirely reversed, with annual growth at just 1.4%, roughly 1/10 its peak level. Adding to the core pulse, food inflation has slowed from around 11% mid-2022 to below 6%, and energy inflation has swung from plus 60% to minus 27% as concerns over the impact of Russia's invasion of Ukraine on commodities receded. Against their averages from the 5 years prior to the pandemic, core goods and food inflation have further to deflate in the months ahead. With a combined weight of almost 10 times that of energy goods, a rebound in energy price growth to its average rate can therefore easily be offset, leading to an expectation of stability in total US goods inflation over the coming year. Of course, we must ask if it is appropriate to assume a return to routine after such a long period of abnormal price movements. In our view, the risks for goods prices are actually skewed to the downside, at least for the next 12 to 18 months. If we first focus on US demand, it is evident that consumers' willingness and capacity to spend is impaired, having run down savings and with a recovery in real income growth slow to come through. In the June quarter, while services consumption was near trend, spending on goods was essentially flat. Further, having accumulated at a rapid rate since December quarter 2021, business inventories look to have topped out through the first half of 2023. This is important for prices because it suggests that not only are consumers holding back, but businesses know their capacity to increase prices is reducing. As relevant for US goods inflation is what is occurring outside the US's borders. Across the developed world, consumer spending has or is in the process of slowing to a crawl, despite historic strength in the labour markets. And the full weight of policy tightening and cumulative inflation is yet to be felt. Meanwhile, in China, flat consumer inflation and deeply negative producer price inflation points to excess capacity. As local government authorities, state-owned enterprise and private firms invest in new and more efficient factories and infrastructure, China's spare capacity continues to grow and the cost of production falls. Importantly, this development is not only occurring in China but across Asia, often funded by large Chinese and Korean firms. This past week, Chinese authorities made clear they intend to make use of growing onshore capacity and efficiency to materially accelerate growth in production and exports of goods to bolster their economy. In a world of weak demand and growing supply, this can only result in disinflation or outright deflation for some manufactured goods. A likely continuation of the favourable turn in goods inflation in the US and across the developed world does not mean all the world's inflation concerns have been resolved, however. Rather, it focuses attention on domestic pressures, particularly in the service sector. For the US, these are chiefly found in the shelter component due to a lack of supply of dwellings for rent and the resurgence of global tourism, which continues to hold up the prices of hotels and travel. Similar situations are evident in other developed markets, albeit to differing degrees, and sometimes with evidence of other capacity constraints. There is a clear conclusion to draw here. Just as Asian investment continues to bring US and global goods inflation back to average levels, so too is developed world capacity expansion necessary to ease service pressures and guarantee a sustainable, broad-based return to inflation at target. We'll see you next time.